Have you ever stared at a Forex chart and just felt lost in the noise? Yeah, we've all been there. Markets can feel totally chaotic. But what if you had a roadmap? What if you had something to help you navigate through it all? Well, that's exactly what we're talking about today.
It's the big question for every trader, isn't it? When prices are just swinging up and down, how do you find any kind of order? How do you spot the signposts that can actually guide your decisions and help you cut through all that confusion? Well, there's a tool that's literally designed to do just that. It's called pivot points, and you can think of it like a GPS for your trading. It gives you a clear structure to work with, day in and day out. Okay, so what in the world are these things? Let's get our bearings here. Think of this as learning how to read the new compass that's going to help guide our trading. So in the simplest terms, pivot points are just a set of levels on your chart, and they're calculated using data from the previous trading day. The formula itself is actually super simple. You just take yesterday's high, low, and closing prices, you find the average of those three, and boom, that's your main pivot point. All the other levels are then calculated from that one baseline. It's kind of like getting a cheat sheet for today's trading that's built from yesterday's action. Now, take a look at this. That orange line right there in the middle, that's the main pivot point, or the PP. Think of that as home base for the day. Now, the lines above it, those are your resistance levels, R1, R2, R3, and the lines below, you guessed it, those are the support levels, S1, S2, and S3. These lines become your key landmarks for the whole trading day. And, the real beauty here is just how simple they are. They're surprisingly easy to get the hang of, which makes them an absolutely essential tool to add to your trading toolbox. All right, so we know what they are, but why should you actually use them? Let's dig into the practical reasons why making pivot points a regular part of your analysis is such a game changer. Well, to put it simply, they help you make smarter decisions at every single stage of a trade. They give you logical places to think about for your entries and your exits, and they provide really natural spots for setting stop losses and your profit targets. Ultimately, they just help you get in sync with the natural rhythm of the market. And here is a golden nugget of information. This is the kind of thing experienced traders build entire strategies around. See, most of the time, the price just tends to bounce around between that first resistance level, R1, and that first support level, S1. Just knowing this one little tendency can give you a huge edge when you're looking for potential range trading opportunities. Okay, time for the fun part. Let's see how all this stuff actually builds into a real strategy. We're going to look at how 3 totally different types of traders can use this exact same tool to their advantage. Yep, that's right. Whether you're a range trader, a breakout trader, or a trend trader, there's a way to make pivot points work for you and your style. Let's check it out. And this is where you really see how versatile this tool is. So look at the range trader. They're looking to buy near that support level S1 and sell up near resistance at R1. Pretty simple. But now the breakout trader? They're looking at those exact same levels, but they're waiting for a powerful move to smash right through them. And then you have the trend trader. They're using that main pivot point, the PP, as a kind of sentiment gauge. If the price stays above it, things are looking bullish. If it drops below, the sentiment's probably bearish. 3 traders, 1 tool, 3 different strategies. Now, hold on. Before you run off and start putting these lines on your charts, there is one absolutely critical role we have to cover. And honestly, this is what separates consistent traders from gamblers. And here it is. Please burn this into your brain. Pivot points are an indicator. They are not a crystal ball. They give you probabilities, not certainties. And relying on them all by themselves is, well, it's a recipe for disaster. Let's go right back to that toolbox idea. You can't build a house with just a hammer, right? You need a screwdriver, a saw. It's the exact same thing in trading. Pivot points are a fantastic hammer, for sure, but you still need all the other tools in your kit. So what's the solution? You need to look for confirmation. You pair your pivot point analysis with other indicators you trust. For example, maybe you see a bullish candlestick pattern forming right at a support level, or you check the RSI and see that it's showing an oversold condition. See? These extra signals build a much, much stronger case for your trade. And this is the key takeaway for your entire trading strategy. Every extra piece of confirming evidence you can find just stacks the odds a little bit more in your favor. It's all about building a high probability setup. So, after all that, what is the one single thing you should remember from this whole explainer? Let's just boil it all down to one core idea. To put it as simply as possible, pivot points are your roadmap.
They highlight those key intersections and potential roadblocks on the chart, and that lets you anticipate what the market might do instead of just reacting to it. And that foresight, that's what leads to better, more confident trading decisions.
So there you have it. You've just added a really powerful new tool to your trading toolbox. And the question I'll leave you with is this. The next time you're sizing up a trade, what are you going to combine with your pivot points to get that all-important confirmation? Happy trading.